Continuation of this quite long mortgage question. You've got to borrow $120,000 to hopefully purchase a house, and you're faced with two options. In the previous video, we worked through the payments under both options 1 and 2. We used the finance solver to find out how much the monthly payments were and how long it would take to pay off all the loan back to a final value of 0. And now for part E, it's just asking to give a comment on which particular option might be preferable. So what I've done is I've just pulled together the main findings from the first 2 pages there. And at the top here, let's just go through them. That option 1, you pay a total of $190,000 back to the bank. Option 2, you pay $181,000. So it definitely seems that option 2 is better because you pay back less to the bank for the same $120,000 loan. Okay. However, look at option 2. The reason why you pay back less is you're paying more each month, $1,000 per month versus $791.95. Okay. And then this also ties in with the above is 181 months in total to pay back, 240. So option 2, you'll pay back the loan a lot quicker. Okay, so you just got to use any of those reasonings basically. So here, give reason why Sophie might choose option 1. So option 1 would be less monthly payments. Okay, imagine that you have a certain salary coming in and you can only manage to afford to pay off $791.95 a month for the mortgage. So you'd go for option 1. And then the reason why you might choose option 2 is less in total to repay, and obviously less time to be in debt. To be in debt means that you owe money to someone. And I think generally people have a natural feel to try and not be in debt and to try and pay back the debt as soon as possible. Okay. Now let's have a look at 7G. This gets a little bit more complicated. Sophie decides to choose option 1. So let's just have a look at option 1. Option 1 is the total cost is $190,068. So that's important to really pin that down. This is quite a complicated question. At the end of 10 years, now 10 years is exactly halfway through the actual loan agreement. So you go to the bank and you agree terms and you set this up as a regular monthly payment from your bank account to the bank basically that you're borrowing from. And so you've been locked in to pay $791.95 per month for 20 years. Now, if you get through to 10 years, then you've actually paid back half of the agreed sum. So you've actually paid back $190,068 divided by 2. So if we get the calculator out, so 190,068 divided by 2. Okay, this is the amount you've actually paid back and the amount you've still got to pay. So this is 95,034 is the amount of money you've still. We have 95,034 paid and we have 95,034 still to pay. So let's have a little look. Use your answer to part A1 to calculate the amount remaining on a mortgage after the first 10 years. So this is basically it. That's what we've found, and it's a simple calculation to do. It's just a number divided by 2, but we have to make sure that we use the actual full amount of the amount of the loan for option 1. Okay, so it's not 120,000 here. It's actually 190,068, the full amount of the loan divided by 2. Okay, and then the final part is calculate her monthly repayments for the final 10 years. So that's another finance solver again. You know, there's so many finance solver parts to this. Finance solver. Okay, so let's just go back and have a look at the question. It says in the extra bits, at the end of 10 years, the interest rate is changed to 7% compounded annually. So let's go and put that in our finance solver. 7% compounded annually. So this is 7 compounded annually, so that CPY is 1. The question says calculate her monthly repayments, so that is still PPY is 12. We've got the final value as 0, but now the present value is how much of her current loan she still has to pay, and that's 95,034. So that's 95,034. And we are calculating her monthly repayments for the final 10 years. So the N is 10 years, and that is 10 times by 12, which is 120. Okay, so let's just transfer all that down. Here's N, I, PV, PMT, FV, PPY, CPY, and that's set to end. So the N is 10 years, but monthly payments, so it's 10 times 12 is 120 payments. The interest rate is now changed to 7. Let's just check that one more time. 7% compounded annually. So 7, and then down here compounded annually. And now the present value is exactly half of the total amount under option 1. The payment is what we're trying to find. The final value down to 0, and the PPY payments per year, well, it's monthly payments, so it's 12. So let's go and finally solve for that. Okay, and you can see that the answer of 1092.92. So it's an increase in payments, of course, because the interest rate is increased. And this is realistic, that sometimes you take out a loan with a bank or a finance company, and it might have a fixed interest rate for a certain amount of years, but then it goes to a variable interest rate, and then that's determined by all the other factors in the economy. So it's very likely that you start off paying a certain amount. So let's think about the monthly payment was previously 791.95 per month, and after 10 years that's gone up to 1,092. So that's a significant increase in monthly payment. And that's just real life. That's what happens in real life, and you have to think about budgeting and accounting for that.